Good morning, everyone, and welcome to day 3 of Equitable Growth's Grantee Conference. My name is Raksha Kopparam, and I'm a research associate here at the Washington Center for Equitable Growth, and I'll be the chair of today's session. It is my honor to be moderating this session on market power in the modern U.S. economy. And before we dive into this incredible research, let me just cover the agenda and a quick few housekeeping notes. So we will begin with a presentation on effectiveness of measures of upward pricing pressure in predicting price changes by Ratib, an associate at the Brattle Group. Next, we will hear from Germán Gutiérrez, assistant professor at the University of Washington's Foster School of Business, who will be presenting on the welfare consequences of regulating Amazon. Ying, associate professor of economics at the University of Michigan, Ann Arbor, will be giving discussant remarks for those two papers. Afterwards, Bruno Pellegrino, assistant professor at the University of Maryland's Smith School of Business, will give his presentation on A Tale of Two Networks, Common Ownership and Product Market Rivalry. And then next, Thomas Wollmann, associate professor at the University of Chicago Booth School of Business, will give his remarks on Pellegrino's paper. We'll have about 10 minutes for each presentation, and each discussant, except for Ying, who will have 20 minutes to cover 2 papers. You may hear me interrupting remarks to keep time. It's not because anyone is doing anything wrong, but because sometimes it's hard to see those like Zoom reminders and pop-ups when you're in the middle of giving a great presentation. So after all of our presenters and discussants, we will turn to the Q&A, which I'll be moderating, and I'm very excited. I'm very much looking forward to this. I encourage all audience members to submit questions into the Q&A box that you'll see on your screen on a rolling basis as you come up with them. I'll try to get to as many of them as possible during the Q&A at the end of this session. Please include your name and affiliation when asking any questions. And also please feel free to use the chat function if there are any resources or thoughts you'd like to share with the full audience in real time. I know I'm excited about this lineup of presenters and discussants in this session, and I know y'all are too. So I'll quickly drop a note in the chat about the tenor of participation we'd hope to see throughout the grantee conference, and I won't delay us any further. With that, I'll turn it over to Ratib to kick us off.
Thank you, Raksha. Can everyone see my screen? I only learned how to share my screen properly like 5 minutes ago, so I'm very impressed with myself. Hey, everybody, I'm here to talk about the effectiveness of measures of upward pricing pressure and predicting changes in price, usually when we're looking at a proposed merger. Upward pricing pressure interests and excites me because in a past life, I was the economist for the Massachusetts Attorney General's Office Antitrust Division, and in my current role at the Brattle Group, I work on a fair amount of competition cases, which is a reminder that this presentation represents the opinions and conclusions of myself and myself only, does not represent any of my affiliations past or present. So this is a work in progress, and therefore any feedback you all have will be highly appreciated. So UPP has gotten more prevalent in the last few years, in part because it improves upon concentration-based measures like the HHI. It does not take a stance on market definition. It's able to account for product differentiation while still having a low enough computational and informational burden. There are many different measures of the UPP. We're going to focus on the gross upward pricing pressure index for the rest of this presentation. The guppy measure is the unilateral price effect driven by the acquiring firm's ability to recapture sales diverted to the newly acquired firm. Asking 2 questions. Number 1, is the UPP a good indication of observed post-merger price change? If no, throw it out. If yes, do we still need other tools to investigate anti-competitive harms of a proposed merger? There are a few measures of UPP that we discuss. As I mentioned earlier, I'm going to stick with the guppy just because it makes the fewest assumptions about the demand function, while still having the least amount of computational and informational burden. There's some discussion on diversion ratio, which is an integral component of guppy, but I'm going to gloss over the theory in the interest of time. I'm going to apply it in the context of the US Airways American Airlines merger that took place in 2013. What I'm going to do is take the pre-merger data, apply the Guppy to have some predictions on changes in price following the merger. Then I'm going to take the post-merger data to compute the observed price change. This is essentially a retroactive analysis, and then compare Guppy with the observed price change. I'm going to do that for the 50 largest airport routes by domestic passenger enplanements. And I'm going to separately do these calculations again for Reagan Airport, just because Reagan Airport had that large slot divestment. Think of a slot as a gate. So DOJ said as a precondition for the merger, US American, you all have to give up a bunch of your gates to low-cost entrants like JetBlue and Southwest. It's a remedy. It's a different thing that happens that usually does not happen in the free market, and therefore requires special investigation. So there's a fair amount of theory, derivations. The purpose of these derivations is to get this simple expression for Guppy, which is diversion ratio times markup times price ratio. And the purpose of these subsequent derivations, which invoke elasticities and an assumption of the multinomial logit discrete choice utility model, which is not an unreasonable assumption, especially in the airline literature, is to get an expression that uses observables readily available from the government databases. So we break this down, break the whole expression down in terms of prices, shares, quantities, markups, and so on. So I have this expression for Guppy, which is a product of three things, which itself is a combination, a function of a bunch of other observables. I can pull all the observables from the Bureau of Transportation Statistics databases. The only number that I'm pulling that's somewhat controversial is the markup, just because the markup available with the government is the accounting markup, not the economic markup. It does not, for instance, account for opportunity cost and so on. So we do some robustness check in this estimation. The markup that's relevant here is the markup of the acquired firm, which is American Airlines. Someone not in the weeds may be a little confused by this, but what happened in 2013 was American declared bankruptcy. US came in and acquired American. US is the surviving firm. The headquarters of the newly merged firm was where US Airways headquarters was. Doug Parker, CEO of US, became the CEO of American. So for all intents and purposes, US acquired American and then used the American brand to continue. Therefore, US is the acquiring firm. American's the firm that did get acquired. For that purpose, we're going to use American's markup of 12%. Some robustness checks, we can take the average industry markup for 2018 as a low bar and an arbitrarily high number of 20% as the high bar, which happens to be the highest markup available for a legacy carrier within our sample size of 2012. As we can see that the Guppy is sensitive to markup. The Guppy does change depending on what assumptions we make, but the observed markup of 12% does a very reasonable job at getting close to the observed price increase. So the Guppy was 6.5%. The observed price increase was 7.5%. And I say this is reasonably approximate for two reasons. One, it's within the same order of magnitude, but more importantly, given the amount of simplifying assumptions we made, being within the same order of magnitude is a sufficient outcome for a screening tool like Guppy. So we say that the Guppy does a good enough job at predicting the observed price increase in this situation. Like I said, we're going to refocus our attention just for Reagan Airport. And here we find the Guppy predicts a 5.5% increase in price. However, we actually experience a 4.25% decrease in price. So what happened was when US and American took a bunch of these gates, gave them to JetBlue and Southwest, these are low-cost entrants that enhanced competition. And the increased competition on Reagan Airport actually decreased the price for routes involving Reagan Airport. That's a really cool outcome. And obviously you can see here two takeaways. Takeaway one, Guppy does a decent job at predicting price changes in the simple case. And secondly, Guppy does not do a reasonable job when we have some complex market remedies or some other changes in the market structure. So the reasonable question to ask is, what can take this into account? And I'm going to suggest a full merger simulation. I'm going to use model from my 2020 working paper, which was so generously funded by the Washington Center for Equitable Growth, to estimate demand coefficients for the restricted sample of 49 routes, the 49 routes being DC to the other top 50 airports in the US. The full merger simulation is going to create a newly merged entity. And I'm going to transfer all of the slots from US and American to this newly merged entity. This newly merged entity is going to be the surviving firm post-merger, and that's going to be the first simulation. The second simulation instead is going to do this whole created the new merged entity bit, but also take away some of the divested gates away from the newly merged entity and give them away to JetBlue and Southwest and create a new ownership matrix of slots. What I observe is the simulation one, or the simulation that did not account for the divestment at all, predicts a somewhat similar percentage increase in price as does the guppy, which is a good indication that the guppy or the merger without the divestment is decently accurately calibrated, depending on what you think the line of causality is. But both the guppy and the merger simulation without divestment produces results in the same order of magnitude. The merger with the divestment or incorporating the divestment produces negative results. Although it's not as close or nowhere near as close as the observed 4.25% decrease in price, it can produce a negative result. And therefore, I'm going to argue that a full merger simulation incorporating all the necessary changes in the market structure is going to get us a better or a more closer approximation to the observed post-merger change in price, even when the price is going in the opposite direction of conventional theory. I'm going to take the last minute to quickly wrap up the conclusions from this study or exercise. So we found that guppy does perform reasonably in the simple case. And once we have some more involved things happening like structural remedies, guppy just cannot. It's not designed to take those into account. So in those cases, a full merger simulation might be time consuming, but provide a more accurate result, which is to say that guppy is a good screening tool, but we need to complement it with something more fulsome before we take regulatory action. And unfortunately for the US-American merger that took place, there are no records of any additional analyses being done for the Reagan Airport divestments before the DOJ made the proposal, and the proposal was gleefully accepted by US Airways. So that's the end of my talk, with the punchline that guppy good, full merger simulation probably better. Thank you.
Thank you so much, Ratib. We are going to move on to Germán Gutiérrez.
Excellent. Can everyone see my screen? Perfect. Well, first off, thanks to the organizer for putting me on the program and for their generous funding for this project. I'm very grateful. So this paper is thinking about Amazon, and in particular, it's motivated by the fact that platforms, including Amazon, but many others, offer many products across very different selling methods, right? So in the case of Amazon, sometimes it acts like a traditional reseller, right? So it goes to Duracell, it buys some batteries, and then it sells them to us as consumers, right? It's unique because it's e-commerce, it has to ship them to us, but this is a standard sort of selling method of, traditional supermarket and pharmacy companies, right? Over the past few years, it also introduced some private label products, right? So in this case, Amazon goes and it produces its own branded batteries, Amazon Basics, and again, sells them to us as consumers, right? These two methods, as I mentioned, are pretty standard, right? Supermarkets have been doing this forever. What's unique about the platforms that are evolving more recently is that they have other selling methods. In particular, sometimes Amazon acts like eBay, right? So it's going to connect an independent third-party seller with a buyer, and this third-party seller is going to set prices and it's going to ship the product to the buyer, right? And a more unique case that's really more specific to Amazon is this case where the seller can contract Amazon to do the fulfillment, right? So the product is sold by this third party, but Amazon is in charge of selling this product, right? And what I want to think about in this paper is how do these different selling methods, these new business models that are coming about, affect both the platform incentives, the welfare allocation across participants on the platform, and how this should inform the regulation that we do of these business models, right? So why do this? Well, first, because it's kind of fun to think about how Amazon works, how a company like Amazon works. Second, because this practice, right, of what's being called a hybrid platform, a platform where a platform acts as a participant and also operates the marketplace, is increasingly common. In fact, most major platforms outside social media ones do this, right? Apple and Google create their own apps and sell them along third parties. Netflix and Spotify create their own content and offer it along third parties. And crucially, right, this has led to a lot of regulatory concerns. Regulators are worried that the platform, by acting as an operator, can steer buyers across different products in order to maximize its own profits, right? And this has led to some regulatory actions, including, for example, the Ending Platforms Monopolies Act, that would essentially ban hybrid platforms altogether, right? But we don't have a rigorous empirical analysis of this, and so that's what this paper is going to try to do. And in particular, I'm going to do this through the lens of an empirical I/O model, where consumers choose across substitute products that are sold under both marketplace and reselling vertical relationships, and where the platform and sellers endogenously set prices and set fees. And the platform does so accounting for dynamic investment incentives, right? In particular, what I mean is I'm going to allow the platform to set lower prices and lower fees today as a way of investing in getting more buyers and sellers on the platform, right? We're going to specify the model, then we're going to take the model to the data. In particular, we're going to estimate it for about 150 categories, right? And then we're going to use the model to run some counterfactuals where we ask what's going to happen to welfare if some of the regulations proposed are actually implemented. Yeah. So the model is going to be pretty complicated. I won't go through the details, but it's going to look like this. We're going to think about buyers visiting the platform, Amazon, to buy products from a narrow category K. So this is going to be like AA batteries, right? When the buyer buys a product, it's going to pay a price PJ, and this PJ is going to be allocated across the different participants depending on the selling methods, right? So when Amazon acts as a standard retailer, I'm going to call this sold by Amazon, it's going to buy batteries from Duracell for a price WJ that Duracell is going to set, and then it's going to set a markup over this W for the price PJ, right? Similarly, when Amazon manufactures the product, right, it's going to manufacture it for a marginal cost CJ, and it's going to set a markup over that for the price PJ, right? Again, as I mentioned, these two are pretty standard, right? This is essentially the problem of a traditional retailer, a traditional supermarket. What's going to be new in the model here is that we're going to have this selling method fulfilled by merchant when Amazon essentially acts like eBay, right? So in this case, Amazon connects the buyer and the seller ships the goods to the consumer, right? The way the economics is going to work is that Amazon is going to set some fees, right? And it's going to include some ad valorem fees for matching the buyer and seller, and some advertising fees that it can charge for putting the product at the top of our screen, right? And the seller is going to take these fees as given, and it's going to set prices. And then we're going to have this fourth selling method that's very unique to Amazon, which is what I'm going to call fulfilled by Amazon, which is a case where the seller contracts Amazon for fulfillment. It ships the goods to Amazon, right? And Amazon then ships the goods to us. And in that case, Amazon is going to charge an additional fee for the fulfillment services, right? So we're going to think about this system, right? Where essentially the third-party sellers set the prices, taking the fees as given, right? Manufacturers set the wholesale prices, knowing the price-setting rule of the platform, and the platform is going to set jointly the prices on the products itself and the fees on third-party products to maximize its short-run profits plus this discounted future value of the platform. And I'm going to model this discounted future value as essentially allowing the platform to put weights on buyer and seller surplus today, right? So what's important to realize about this system is three things, right? First is that the platform makes money no matter what we buy on Amazon, right? It will make fees if we buy from third parties. It will make a markup if it will buy from the product sold by Amazon, right? And so these cross elasticities across products and across selling methods are going to discipline how the platform set prices, right? Second, and so what's going to matter is going to be the rate at which consumers leave the platform when prices rise, as opposed to switch to other goods on the platform, right? So essentially, Amazon is going to be setting price according to the aggregate elasticity, not the own product elasticity, right? That's the first one. The second one is we have to realize that when we buy from Prime, we're either buying from Amazon or we're buying a product that is fulfilled by Amazon. So to the extent that we like getting our goods in 2 days, that's going to allow Amazon to either set higher prices on its own products or set higher fees for the products that it fulfills. Right? And last is, to the extent that consumers really like Amazon and don't switch to the outside good, and they have limited attention, that's going to allow the platform to set higher advertising fees. Okay? So we're going to estimate the model and take it to the data. I don't have time to go through the details, but I just give you a summary of what comes out. Right? And what this table shows is the average estimated parameters across about 150 categories. Right? Now, I find that the own elasticity of demand is pretty high. It's about minus 5.8, right? It means that sellers are setting a markup of about 16%, right? However, when prices rise, only about 30% of consumers actually leave the platform, so that the effective aggregate elasticity that Amazon faces is only minus 1.5, right? If we assume that the platform is not investing, right, so it's just maximizing its short-run profits, we can solve the model and we can find what would be the optimal fees that the platform would charge, right? And in this case, right, given the relatively low aggregate elasticity, the platform would charge very high fees of about 40%. Right? Now, in reality, I see that for these categories, Amazon charges only about 23% fee, right? And so I'm going to use this wedge between the short-run maximizing fee and the fees that we see in reality to pin down these investment incentives, right? How much Amazon cares about giving buyers and sellers surplus today so that they keep coming back to the platform, right? So this wedge is pretty large, which tells us that Amazon is investing quite a bit, right? And I'm going to use the allocation of fees across products to pin down the relative weights across participants. And in the end, what I find is that Amazon acts as if it puts a weight of 1.1 on buyer surplus and only 0.2 on seller surplus for the median category, right? Which is intuitive relative to a lot of the discussion of Amazon, that it really cares about consumers, right? We see this consumer tilt. And second, we see these relatively high investment parameters, which tells us that Amazon is using its flexibility not just to extract surplus, but also to create and allocate it across the participants, right? So now that we have the system estimated, we can think about, well, what's going to happen if we impose some structural separation? I'm just going to show you one today. In the paper, I do several more. And this one is thinking about what would happen if we split Amazon into 3 different businesses. One that is just a marketplace, it just connects buyers and sellers. A second that is a fulfillment and advertising provider, right? And it's going to charge a unit fee. And a third that's a retailer that's just going to offer products to us and charge a markup, right? Of course, when we do this, we eliminate all of the foreclosure incentives, right? The incentives to raise fees to get buyers to buy products direct, but we also lose all of the gains from coordination and internalization, right? So what happens really is that all of these fees and the prices are going to adjust, right? Because we lose the internalization. And we see that the ad valorem, the marketplace fee would fall, but then the fulfillment and advertising fee would rise. So that the total fees on third-party products would actually be higher, right? And the markup on first-party products, the reseller would lower its fees, right? But in the end, we see that the total share of products sold decreases, meaning consumers are worse off, and sellers are also worse off because they're facing higher fees, right? The big winners here would be the manufacturers, right? Because if reseller markup falls, so they get to sell more products, right? But overall, both Amazon and all the participants on the platform welfare would decrease, right? So what this tells us is essentially that implementing a structural separation on Amazon, given the investment incentives today, would decrease rather than increase welfare on the platform. Right? So just to conclude, this overall analysis tells us 5 things, right? So first is that any intervention that is imposed is going to induce an endogenous response of fees, right? That can offset a lot of the initial gains from intervention, right? Second, that these interventions have important distributional consequences that different participants may benefit or lose from them. And so we have to be clear about, what is the objective of the regulation, which participants we care most about. Third, and this is really the most important, is that hybrid business models are not a priori harmful, right? But this trade-off, these platforms are trading off gains from internalization against foreclosure incentives, right? And so the outcome of banning hybrid business model is going to depend on the investment incentives. Given the investment incentives I estimate for Amazon today, the gains from internalization exceed foreclosure incentives, and so welfare would decrease. But of course, if the investment incentives continue to decrease, if Amazon gets more and more market power, there will be a point in which structural separations may actually increase welfare. And more directly from the analysis, we learned that consumers really value prime and product variety, so it's important to preserve these gains in any regulatory intervention. And last, that the bundling of prime with fulfillment and advertising is really key to Amazon's business model. So, thank you.
Thank you so much. So I'm going to pass the mic over to Ying, who's going to give her remarks on the two papers we just heard.
Can everyone see the slide?
Yes.
Great, thank you. Thank you, Raksha. And thanks a lot to the organizers for inviting me to discussing these two very interesting papers. This is my first time discussing two papers simultaneously. So I was thinking, how do I link these two papers? Okay, so after this slide, you will see the link. So the first paper is a post-merger evaluation of methods that we use to evaluate mergers. So it asks the following question: which method works well? And the paper compares two methods. One is UPP, one is merger simulations. And it finds that at least for some markets, the structural estimation combined with merger simulation works better. The second paper asks how do various regulation policies regarding Amazon affect consumers and sellers on the platform as well as Amazon profit. And the approach is exactly what the first paper says works better, which is structural estimation plus counterfactual simulations. So that's one link. Another common feature of the two papers is that both papers study important industries and have important implications for antitrust. So the first paper studies merger evaluation method. We know that mergers can affect welfare in important ways, which means merger evaluation tools are important, which means evaluating merger evaluation tools can be important. So that's one reason why this paper is important in my view. And also, as mentioned, the paper studies an important industry, and the specific empirical context used in the paper is the American Airlines and US Airway merger in 2013. Second paper studied Amazon. So I don't think I need to say more about why this is important. Amazon is important. This morning news says that FTC is looking to get more data from Amazon about their acquisition of iRobot. So Amazon is in the news all the time. Amazon is important. And also Amazon plays different roles on Amazon. Amazon is a platform, a retailer, and also sells private label products directly. Amazon has market power over buyers, us, sellers, and manufacturers. And moreover, currently, there are all kinds of discussions about regulating Amazon. So both papers are super important. Let me start with the first paper, Alice paper. So Alice paper focuses on horizontal mergers. When two papers who previously compete with each other merge together, the firms are going to internalize the following positive externality, which is as I increases my price, my competitor firm J can benefit. So there's a positive spillover effect in externality. And after merger, I'm going to internalize that, which means higher prices. And of course, there might be cost synergy as a result. That's a force to drive down the price. There can also be product adjustment, firm entry, etc. This paper is going to focus on the pricing effect of merger. So what is UPP? UPP is measure to measure pressure or incentives to increase prices at the pre-merger equilibrium. and it depends on margin on the firm's current products and the diversion ratio to the merging partners' products. Okay, so as I mentioned, this is a measure at the pre-merger equilibrium, but it may be related to how eventually prices may be adjusted after merger. So here's a quote from Farrell and Shapiro, which is to say that hard-kicked balls tend to go further. So even though UPP is a measure at the pre-merger equilibrium, it may be related to where eventually price go after merger. Merger simulation is quite different. So we first use pre-merger data to estimate demand, back out marginal cost, so that we match, combined with some unobservables, we match the data perfectly as the equilibrium outcome. And then we do a merger simulation, keeping a lot of things the same as pre-merger. We allow the market structure to change. Very often we assume the demand is exactly the same as pre-merger. We may keep marginal cost to be the same. We may do something like a scenario analysis. Let's say, what if marginal cost decreases by what? What if marginal cost of the joint products of the merging parties products decreases by 10%, 15%? One example is Neville's 2000 paper. Alternatively, maybe we're in a setting where we can estimate what the marginal cost may be after merger. So I did that in my 2013 paper when I studied ownership consolidation in the newspaper market. And Jonathan Elliott and Paul Scott and co-authors also estimated post-merger marginal cost efficiency level in the French telecommunication market. Anyway, so we very often assume demand is the same, and we make certain assumptions about marginal cost, and then we simulate the outcome given the demand and the marginal cost and given the new market structure. So that's how merger simulations are typically done. So you can see these are two very different approaches. What the paper finds is that for routes that involve the top 50 airports, we find that on average, the observed price change is 7.6%, and the UPP measure gives us something quite close. But if we zoom into the Reagan Airport, routes coming out to the going to or coming out from the Reagan Airport, we find that the data tells us the average change is negative because slots were divested to low-cost carriers. UPP, not surprisingly, give us a positive estimate, and the merger simulation at least gets the sign right. All right, my first comment is about the observed merger effect, which is used as a benchmark. So the paper uses the following measure. It's a ratio. The numerator is the difference between the 2015 price and the 2012 price before and after and before the merger. And the denominator is the pre-merger price in 2012. So that's the measure used in the paper as a benchmark, as observed merger effect. But we know that the observed price change could be driven by many other factors. For example, it's a bit unclear to me whether these prices are deflated. And also, I wonder whether there are some kind of diff in diff specifications that we can use to isolate the merger effects. So that's the first comment. Second comment is this. The paper compares the observed measure with UPP measure for all top 50, which is a great work. And for Reagan Airport, it compares the data, UPP, and the merger simulation outcome. And it seems to me that it's a little bit trivial to say that the UPP does not do very well for markets with remedies, with divestitures. Okay. And so there is a natural question, which is, does a merger simulation also perform better in markets with no remedies? So I would suggest that the author compares data, UPP, and merger simulation for all the top 50 markets. The paper reports the average result only. I personally would find it very interesting to know in what kind of markets does UPP perform well? In what kind of markets does merger simulation perform well? So I would suggest that the author could potentially think about report comparison across all the markets instead of just reporting the average. And also, what explains the gap between merger simulations and observed price changes? Can we learn a little bit more by making the simulation, merger simulation a little bit richer? For example, maybe the gap is explained by product adjustment that we don't take into account in merger simulation, explained by airline entry and exit. Do we see that? And maybe there's cost synergy. So the last comment about this paper is that I didn't find the literature review section super useful. I think if the author could do a so-called case review, that would be great service to the profession. Okay, for example, in what kind of cases, in which cases we observe that UPP was used to indicate that prices are likely to increase? And in what cases UPP are used to literally do prediction as a measurement of the magnitude of the price change? And when do we observe that UPP combined with merger simulations, and when UPP was not taken too seriously, and what's the outcome of all these cases? And I think, you know, a comprehensive review of these cases would be of great service to the profession. So those are my comments about the first paper. Now, moving on quickly to the second paper. Amazon is interesting. It plays many roles, and we see many different kind of market structure. It's a reseller where wholesalers sell products to Amazon. Amazon as a retailer sells to us. Okay. And it also sells private label, directly produce things or outsource to some company, to a factory to produce it, and then sell to consumers. It's also a platform where merchants list their products on Amazon. And so we get to know the existence of this merchant, this product, and we buy from the merchant directly and through Amazon though. And so here Amazon is a listing platform, and sometimes Amazon is a listing platform as well as providing extra service that merchants ship stuff to Amazon, and we buy from Amazon. We buy from the merchant, but it's fulfilled by Amazon. So you can see that Amazon plays different roles, and a vast majority of the transactions done on Amazon are either in the last box where Amazon serves as a platform with extra service, or in the first box where Amazon is a retailer. And this corresponds to very different market structure. In the first box, where Amazon is a retailer, is a double marginalization market structure, double marginalization model. And second, we see vertical integration, upstream, downstream, upstream wholesaler, manufacturer, downstream retailer merged together. So that's a vertical integration model. And in the last two boxes, we can consider this to be upstream directly set price and sell to consumers either directly or fulfilled by Amazon. But in both cases, the upstream merchants make pricing decisions directly. And in the paper, as Herman mentioned, the paper is, the model is quite complicated. So I'm just going to list the agent and their decisions. There's three sets of agents in his model: wholesalers, who make a decision about wholesale prices, and merchants, they make a decision about retail prices, and Amazon, who makes a lot of decisions, retail prices when they act as retailers or vertical integration retailer, the two types of fees, platform fees and fulfillment fee. What is not modeled, another nerdy way to say it, what's taken as fixed in counterfactual simulations, is that merchants do not decide, in the model, merchants do not decide whether to use Amazon fulfillment or not. And also, Amazon does not decide which product to sell as retailer and what kind of private label products to sell. Herman is very aware of this caveat and made it explicit in the paper. And the paper finds that Amazon cares about its own profit as well as consumer surplus and seller surplus. And if we split it, Amazon into a platform Amazon and a retailer Amazon, we will find that consumers are worse off, sellers, the merchants are worse off. Amazon profit decreases. The only group of agents who are better off is the wholesalers. And if we ban Amazon from selling on its own platform, then we will find that consumers are worse off and wholesalers are worse off. So these results are really interesting, and one could imagine that some may find them provocative, to say the least. So I think it's really important to make sure that the results are credible. And most of my comments are about the credibility of the result. So I'm going to start with a quick comment about demand estimation, and then I will also have some comment about supply side modeling, identification, and data. So a minor comment about demand estimation. The paper assumed that there's no heterogeneity in consumers' taste for Prime. But we know that Prime fulfillment is more valuable for consumers with Prime membership, which may be correlated with their price sensitivity. And so I'm wondering whether there's some aggregate variation in the number of Prime members over time. Maybe that can help to identify this heterogeneity. So that's my minor comment about demand estimation. Moving on to the supply side, the paper backs out seller marginal cost based on seller pricing decision and the corresponding first order condition. And there's an interesting feature on Amazon, which is Amazon charges a 15% referral fee for products with a price above $10 and a lower fee for products below $10. So I'm curious whether we see bundling at the price $10. This is something that Germán can see from the data. And if no, it's interesting, but no, fine. But if there is bundling, I'm wondering whether it is okay for the model to ignore this feature, and how would that bias the estimate of marginal cost? Again, about the supply side, the paper assumed linear pricing and double marginalization. But it's Amazon we're talking about, right? Not a mom and pop shop. And so is it possible that there's nonlinear pricing between Amazon and the upstream wholesalers? And I understand that it's impossible to get such data about the nonlinear, potentially complicated contract. And I face similar issues in a study with Chenyu, where we have upstream smartphone manufacturers and downstream retailers. And we don't observe their contract, but we did a set of robustness analysis. So I'm wondering whether Germán can borrow that idea. And finally, identification of the weights. So in the paper, Amazon's objective function is a sum of 4 items: retailing profit, fees collected when Amazon serves as a platform, and a weight times consumer surplus and the weight times seller surplus. The paper finds that both weight 1 and weight 2 are positive. So it would be, and this estimate are important for the counterfactual simulation result for the conclusions drawn by the paper. And so I would like to see a little bit more discussion about how these weights are separately identified. Are there some exclusive shifter that shift one without shifting the other? So I think this would be important to discuss. And last slide about this paper, I would like to see a little bit more in data description. I think this is amazing data, and across many sectors, really would be interesting to know what kind of products are offered on Amazon as private label. Amazon label some of them as Amazon Basic. Are they kind of low-end products? And do these private label products compete head-to-head with third-party merchants' products, or are they in the niche segment of the market? And do Amazon retailing products compete head-to-head with third-party merchants, or again, they go to niche, we only buy niche products? And do we observe systematic differences in prices across the 4 types of channels? And are there systematic differences in review ratings? So as I mentioned, that the paper has really amazing data. I would like to see more detailed description of the data. And finally, let me wrap up. These are really 2 very interesting papers. If you haven't read, I highly recommend. And both are about very important antitrust topics. So I very much look forward to the next revisions of the next versions of the papers. Thank you.
Thank you so much, Ying. I just want to let the authors of the two papers know that you will have a chance to respond to comments towards the end of the session. So keep any of your questions in the back of your head, but we'll move on to Bruno.
All right, can you see my my slides? And can you hear me loud and clear? Excellent. So first of all, thanks a lot to Equitable Growth for funding part of this project, which is joint work with Florian Ederer. And this paper is really about common ownership. Therefore, I'm going to first define it for those who are not familiar with this particular literature. So we talk about common ownership to define a situation where two or more firms that compete in the product markets are also owned by a small and overlapping set of shareholders. Now, why do we care? Why would we care about common ownership? It's because of the so-called common ownership hypothesis. It goes all the way back to a paper by Rothenberg in the 80s. And here is how it works. Imagine a standard oligopolistic market where a bunch of firms competing with each other. But assume the following: instead of the firms maximizing their own profits, which is the canonical assumption, suppose the firms instead maximize shareholder value. Now, we tend to use these two concepts interchangeably, but there is a difference. If I'm out to maximize the income earned by my shareholders, and I'm an oligopolist, I have to internalize the fact that when I change my supply, I'm going to affect the profits of my competitor, who may be owned by the same shareholders that have shares in my firm. Okay, and so the implication of this common ownership hypothesis is that in an oligopolistic industry, the presence of common ownership will lead to a softening of product market competition, and these are unilateral effects. Now, why did we write a paper about common ownership now? Because there's evidence that common ownership has been rising dramatically in the United States, but also elsewhere. So what that means is that as the asset management industry has consolidated, what happens is that the ownership of US corporate stock is increasingly concentrated in the hands of a few large institutional asset managers. And now this is obviously creating a lot of interest from both the policy community as well as the academic community. So what do we do in this paper? In this paper, what we're trying to do is to make a quantification of the economy-wide welfare impact of common ownership. And just to be clear about what I mean by welfare impact, I mean the deadwill loss generated by common ownership and the effect on consumer surplus. Can we say something about that? Now, this seems like a seemingly impossible calculation to make because it depends on two very complicated objects. It depends on the network of product market rivalries that exist between firms. So we need to compete to know who competes with whom. It's not like just standard IO setting where we have an industry and we define the relevant market. We have to define multiple potentially interlinked markets all at the same time. At the same time, we also need to know the network of common shareholders that exists between firms. So we need to know who owns what. So what do we do in practice? In this paper, we propose a new general equilibrium model of oligopoly with two special features. The first is going to be an IO-style hedonic demand system that comes from my John Berke paper. And I'm going to show you how we take this model to the data for the universe of US public corporations for every year between 1994 and 2018. We're going to do that using some very nice product similarity data by Oberg and Phillips. And second, the model is going to feature shareholder value maximization. So we're going to have common ownership effect, and to discipline the network of common shareholdings between firms, we're going to use institutional shareholding data from 13F regulatory forums. So just to be clear, what I mean by shareholder value maximization. So this is the firm's objective function. We're going to have a bunch of investment funds, which we denote by Z, okay? Then we have a bunch of firms that we call generically I, and SIZ is going to be the number of shares that fund Z owns in firm I, okay? So the total income of fund Z is going to be V of Z. It's going to be all the profits of all of the firms I weighted by the number of shares that Fund Z owns in company I. For simplification, we normalize the number of shares to 1. And what firms do, they're going to pick their supply, QI, to maximize the following measure of shareholder value. We call it phi. This is the objective function of the manager of firm I, and it's simply equal to the income earned by all of the Fund Zs weighted by how many shares they have in firm I. Okay, so this is our, and we follow Rothenberg and many other papers, but I'm going to show you how we can generalize this later. Now, the nice thing about this formulation is that we can rewrite the firm's objective function phi as the sum of the firm I's profits plus the profits of every other competitor J weighted by some coefficient kappa ij, okay? And the nice thing is that if you know all of the shareholding, all of the SIZs, you can actually compute this kappa in closed form. Again, kappa is how much weight the manager of firm I puts on the profits of competitor J. So basically, this is going to be the objective function of the firm. So now moving on to the product market side, as I mentioned, we use the generalized hedonic linear demand developed in my job market paper. And here's how it works in a nutshell. We're going to have a matrix A, and by there has products on the columns and characteristics on the row. So this matrix A tells us if we buy 1 unit of each good, how many of the characteristics contained in each good the consumer gets. Okay, so we're going to model products as bundles of characteristics. And it's possible to show that the elasticities of this demand system will depend on the matrix A transpose A, which we call the matrix of cosine similarity. So the elements, the entries of this matrix A transpose A are going to indicate how similar is the characteristic constant of every 2 goods, okay? Why is this important? Because the Auberg and Phillips provide in their famous data set an estimate of these objects. So it's going to allow us to take this model, this demand system to the data. Now, what happens is that firms are going to play what is called a network game of oligopoly. Why is it a network game? Because there's 2 basically very important objects. One is the matrix of cosine similarity, of product similarities, and the other is the matrix that contains all of this kappa ij, all of the profits weights. So you can think of these 2 matrices as being the adjacency matrices of 2 networks. And so that's why the paper is called A Tale of 2 Networks. So these are the 2 networks, the networks of product similarities and common ownership. This is basically what the profits of all firms depend on. So what you're looking at here, in each dot in this diagram, in each of these 2 diagrams, is a publicly traded firm, a real firm in the data. In the left diagram, the connections represent product similarity as measured by Auberg and Phillips. So in some sense, this is going to map our competitive landscape. So 2 firms that are close together sell similar products that are highly substitutable. On the right-hand side, we have the links represent these kappa weights that tell us how much weight each firm puts on the profit of every other competitor. Now, what I want you to think in your mind, imagine about overlaying these 2 networks, one on top of the other. Where the links of these 2 networks overlap, that's where the effect of common ownership is stronger. So the anti-competitive effect of common ownership are going to be stronger for firms that produce similar products that compete closely with each other, and for firms that have few and overlapping shareholders, that is, they have a high kappa. So it's really an interaction effect of these 2 networks, and we observe both in the data, and so we can do counterfactuals. So how do we measure in practice the effect of common ownership? We basically take the observed world, which we assume to be a world with shareholder value maximization, and we compare that, we compare profits and consumer surplus and everything else to an alternative world where firms maximize profits simply. So they're a profit maximizer, or alternatively, you can think about setting all of these kappas exogenously to 0. Okay, and we see what is the difference in profits, that's the green line, and the difference in consumer surplus, that's the dark line. Okay, so if we look at the most recent year in the data, which is 2018, we find that the common ownership increases profits by about 6 percentage points, and it depresses consumer surplus by nearly 19%. So these are huge effects. Now, what happens if we walk all the way back to 1994, which is the beginning of our sample? We found that these these effects are almost absent. They're less than a tenth in terms of size. So what this is telling us is that not only these effects are large, but they're really new. It's something that has emerged over the last 25 years. And this is the effect on profits and consumer surplus. What about efficiency? For efficiency, we look at the deadweight loss, okay? So the change in total surplus. Now, for now, ignore all of these other lines, only focus on the light green line. That is the change in total surplus, so the deadweight loss for the baseline model. And what we find is that the deadweight loss is about 4 percentage points of total surplus in the most recent years. And again, if we go all the way back to 1994, the effect back then was about 1/10, so about 0.4%. Now, what the other lines in this graph show you is how this measure of the deadweight loss change when we change the weighting function. So the initial assumption is that which is the usual one in the literature, is that we weight each shareholder proportionally to their shares. So what we're doing here is we're doing robustness on the weighting function. We're trying other weighting functions that have been suggested by the literature. Long story short, what we find is that as long as we use a reasonable weighting function, our results really don't change very much. We find a large deadweight loss that increases very sharply over time. And I think at this point, I'm pretty much almost out of time. So we do other robustness checks. We use different treatments of costs. We can do Bertrand. I'm probably out of time, so I just want to conclude. So what we do in this paper is this is the first paper to actually try and put a dollar figure on the welfare cost of common ownership across many different industries. We find that the potential welfare effects of common ownership are large and are likely to have increased over time. Of course, we still what this model doesn't answer is basically what is the actual conduct assumption. For that, we need to do conduct testing in different industries, and that's probably where the research will be heading next. And I'm out of time, so I'm very much looking forward to the discussion of Tom.
Thank you, Bruno. So yeah, pass it over to Thomas.
Thanks, Raksha. I appreciate the opportunity to discuss a terrific paper. I think Bruno did a good job of explaining most of this, so I will keep my summary here brief. In short, the authors are going to ask, how large is economy-wide harm from common ownership? So this is obviously not just an important research question, but an ambitious one. Conceptually here, the model has two relevant agents. So one set of agents are going to work, own, and consume, and the other set are going to manage firms, which engage in Corno competition. Critically, the managers are going to internalize the fact that their investors have cross holdings. So, for example, I think this is clear to everyone, but in the event it is not, the CEO of, say, Coca-Cola appreciates the fact that his or her shareholders also own stock in PepsiCo. This internalization is going to move markets away from competition towards monopoly, and that's going to come with all the typical atrocities of like deadweight loss, for example. So the authors are going to estimate the model and borrow some parameters from prior work. They're then going to shut down the common ownership effect, and that's going to allow them to quantify the harm associated with common ownership, which is going to turn out to be on the order of hundreds of billions of dollars every year. I want to start out by saying, prefacing this by saying that I should probably be a relatively unfavorable discussant of a paper like this, in the sense that first, though I strongly support research in this area, I tend to be at least skeptical of the most conspiratorial versions of the common ownership hypothesis. Second, my work is mostly in the arena of structural I/O, which looks even more skeptically at economy-wide economic analysis. And I think third, and maybe worse yet as a graduate student, I completely skipped the general equilibrium section of macro. And so my formal training really doesn't go beyond Edgeworth squares. It turns out, though, that I am the opposite, a very favorable discussant of this paper, I think for three reasons. First, various findings in this paper in particular, which I'll describe, make it almost impossible to ignore developments, especially recent ones, towards a common ownership hypothesis. Second, Bruno's clever 2019 paper, I think, makes it possible to plausibly estimate some economy-wide preference and also production parameters that I didn't think really previously, at least, that we would be able to recover. And I think the authors offer what would best be described as textbook level clarity, both in terms of their overall exposition and the model. And so I think almost anybody can very quickly ascertain how the data maps to the parameters of interest here. And as a result, if there's obvious flaws in the paper, I certainly didn't see them. I have a few suggestions nonetheless. So first, the authors tend to assume that mostly everybody is on board with the common ownership hypothesis. But as I said, I think that skepticism lingers. And I think that in many ways they could push back, at least in the introduction, and in particular use some of the findings that they discover. So for example, I think the largest camp of skeptics says that ownership is simply too fragmented for this to matter. But the author's figure 8 in particular very quickly dispels this myth. That is, nearly all of the common ownership effect today is driven by funds that have holdings of 5% or more in the target organizations. So these are not very small atomistic positions. And I think it's painfully clear from the sharp rise in the dotted line at right. Also, I think for those that say that this phenomenon just simply does not occur, even those skeptics are forced to concede that at this point, the cat is out of the bag, so to speak. And so even if managers have not been internalizing the cross holdings before, they may soon do so. And as a result, even if the common ownership hypothesis is currently dead wrong, this paper's results, in a way, are an extremely important contribution because they show how much harm will result if they're not stopped, if you will. And there's an analog to my own work in 2019 and 2020. I wrote papers exposing reasonably large loopholes in U.S. antitrust enforcement. And while the authorities have been working hard to close these loopholes, several practicing antitrust attorneys have indicated to me that the firms are working just as hard trying to get through the loopholes before they're closed. So I think that's especially relevant here. And I think it could be emphasized. Second, and especially in the spirit of equitable growth, there's a natural question as to what happens if employment doesn't completely align with ownership. So the authors assume a representative consumer whose budget set is wages and profits. But as Gordon Gekko famously pointed out in the movie Wall Street in 1987, about half of the wealth in this country is held by about 1% of the population, more or less. That's important because if common ownership boosts profits that may not flow back to ordinary citizens, and if consumers have convex preferences over products and consumption that is that's non-leisure and leisure, then unless I'm mistaken, there's a possibility here that the authors vastly understate the harm to consumers with this type of representation. I'm not sure really how to handle this. Perhaps this is a second paper entirely, but the budget constraints here may be very different than those that apply in practice. And in a way, if they were to account for that, it may turn out that they're underselling their overall results. So I think it's an important consideration. And finally, on the other hand, I wonder about two mitigating factors in particular. So for one, the authors let managers or let the common ownership affect horizontal competition, but not necessarily vertical relations. So that impacts the managers on one dimension, but not the other. In theory, if we put aside the possibility of foreclosure, vertical semi-integration, for lack of a better term, will probably reduce double marginalization, which is going to benefit consumers. I don't know how big that benefit is, but it's definitely worth thinking about because it's potentially large. And I think for another, as the phenomenon grows, at some point, I would expect the overall incentives in the market to shift. And in particular, I'd expect that there's going to be incentives to free ride by taking firms private. They should rise as well. Entrepreneurship, entry, and so forth may come at the same time. Personally, I find it pretty interesting that the behavior studied here by Florian and Bruno coincides with secular trends in public and private capital formation, and in particular, a drastic rise in private equity. So that may very closely relate. And I think that is impossible to ascertain without having what Florian and Bruno have done here. So I think I'm just out of time. I will leave it at that. I think this is a paper where economists and policymakers alike will learn a lot from reading it. Thank you very much.
Thank you, Thomas, and thank you to all the other presenters and discussants. Before we jump into the Q&A, I want to give presenters a chance to respond to their discussants' remarks. So Ratib and Germán, if you have any comments, I open the floor up to you. And while presenters are responding to comments, I encourage the audience to put any of their questions in the Q&A box because we'll get to them shortly.
Okay, I mean, I can jump in briefly. So Ying, thank you very much for your discussion. I think it was super helpful. Yeah, so I think most of the comments, I agree. I think the descriptive part is super interesting. It's something that I'm working on now. In terms of the estimation of the different parameters for investment, they're basically pinned down by the level of those parameters is pinned down by the difference in the fees that Amazon charges from a short-run maximizer to those in reality. And the allocation between them is pinned down by the difference in incidence on buyers and sellers of ad valorem relative to unit taxes, right? So essentially more unit taxes tend to have a higher incidence on consumers. And so the fact that Amazon uses more ad valorem taxes tells us that it's tilting towards consumer. That's kind of how that's pinned down. And then your comment on demand, it's valid. I think it's tricky to get random coefficients, but it's something that I'm given sort of the size of the data that I have and some estimation problems like zeros of demand and so on, but I'm trying to get there. So,
yeah, Ying, thank you so much. The comments were super helpful. There is a discussion on the performance of merger simulations and how it relates to the overall market in another paper of mine, but if I want this paper to be a standalone paper, I need to make that incorporation. So that was a very helpful observation. The comment on showing results for all 50 markets should be straightforward and it should be interesting. The review of cases will be more challenging, but I think the results will be a lot more interesting. So I appreciate that feedback. This is the first time I've heard of something like this. So in the context of this paper, so I'm very intrigued. I need to put some thought into it. I also need to put some thought into explaining the gap between merger simulation and the observed price changes. I'll have to think about how to approach that issue, but that's also very useful. So thank you so much. It's given me a lot of fodder for thought, and I'm assuming you'll be fine if I reach back to you once I have like some of this more fleshed out. Appreciate it. Thanks.
Absolutely. Sure.
So I just wanted to say thanks a lot to Thomas for the very nice discussion. So just wanted to reply quickly to the point about how skeptical we should be of the common ownership literature. Actually, I'm very sympathetic to your comment. I'm myself relatively doubtful about how pervasive these common ownership effects are. They really depend on the firm conduct. But I really like the way how you, in some sense, you pitched our contribution. Even if we don't know exactly what firms are maximizing, I think it's important to know what the effects will be. And I think we can perhaps tweak a little bit the text of our paper to sort of make it this a little bit clearer. And in terms of incorporating vertical relationship, I've been trying to do that for a while. We do have some data on the input-output linkages between firms in Compustat. So far, it has been a little bit difficult to integrate these input-output linkages in the linear quadratic framework that we employ. So if you have any reference, I'm actually looking for ways to do this. So if you have any reference, that would be great. What we can do in the meantime, until we figure out how to do that, we can actually, there's a way to adjust the Oberg-Phillips cosine similarity measures to sort of make sure that they don't accidentally capture vertical relationship. So that's an additional robustness check that we can do. It will not allow us to capture the welfare improving sort of effects of common ownership that go for vertical relationship, but at least it will make sure that in some sense we don't count vertical relationship as horizontal. So that's what we can do in the meantime. And if you have any suggestion on how to incorporate the vertical relationship, that would be terrifically useful. And thanks a lot again. This is thank you for doing this.
Great.
Wonderful. And I also want to give all of our panelists an opportunity to ask questions about each other's research, if you have any. And if not, we'll open it up to the Q&A box.
So actually, I got a question about Germán's paper. So of course, the model is clearly very complex, and you didn't have the time in 10 minutes to go through all of the specific. I was curious whether, in some sense, you model in some way the ability of Amazon to give more prominence in their platform to certain products over others, and whether I wasn't able to capture whether that was modeled from your brief presentation.
Yeah, so great question. The short answer is not really. I don't think about things like self-preferencing and so on. The model can accommodate that. In fact, it would be easy to extend it in that direction. The hard part is getting the data about how this sort of placement is playing out over time and so on. But right now, I essentially abstract from that altogether. I think there's other work, in particular by Leon Musov and Devesh Rabal at the FTC, who think about the self-preferencing hypothesis, in particular in the context of the buy box. So really think about within many sellers that are offering one product, how Amazon can use its algorithms to benefit certain products or sellers, right? But yeah, I don't do it here. I'm really focusing on fees because I think that's really the most important dynamic that we've seen over time. So Amazon has essentially increased fees from about 18% to 34% since 2009. So I think, while self-preference is important, the fees are really where the money is. And that's what we need to understand more.
Thank you.
Alrighty, anyone else want to pose any questions? Okay, well, we do have one question from Katie Wilcoxon of Equitable Growth. She asks, what gives you hope when you look at the market concentration policy landscape today? And this is a question for all panelists, so anyone feel free to jump in.
Raksha, maybe I'll just jump in for a second and say that it has been encouraging that I think the agencies have been aggressive in addressing many of these issues, that the horizontal merger guidelines or merger guidelines generally, which are written by the DOJ and the FTC, are in the process of potentially being revised to address a lot of this, which I think is good. And in many cases, I think we'll see bipartisan support, especially when it comes to tech. So I think there's a lot to be optimistic about. And then I think on the other end, echoing somewhat of my comments before, as industrial organization in particular turns its sights towards some of these problems and exposes some of the issues, I am modestly worried about how quick the policy can respond relative to the private sector actors. In my own case, I think it was it became clear that you have to be very aware when you write a paper which clearly exposes a loophole, that people do not jump or herd through that loophole very quickly and walk or even gallop through it. And so, but I think having more people involved in these decisions is going to help anyway. And there seems to be increasing attention turning to them. So,
thank you.
I can add that I will also be very optimistic about the fact that there's been really an explosion of research on market power and concentration over the last few years, and it has come from many different subfield of economics. I think that is great. I mean, there is interest. So as a profession, we took notice of this trend, and we're looking very deeply. We're looking very seriously in trying to analyze where they come from. We don't have a complete picture yet. There are clearly some very important changes that arrest in our economy. And I think this is when we look, for example, at the number of job market papers in the rookie market for economics professor that are dedicated to market power, concentration, superstar firms. I mean, it's clear that it's a very, very hot area of research, and so we're understanding more and more about these topics.
Thank you. Herman, I see that you were off mute. I don't know if you want to jump in.
No, I mean, I mostly agree with what was said. I think there's a lot of action going on, both on the policy side and the research side, and maybe we're a little bit behind the ball, but hopefully we'll catch up. So that's what gives me hope.
Yeah, we're definitely behind. And the one fear I have is we might choose to overcorrect once we start getting into the process. A, either because we're overzealous and frustrated, or B, because we're predicting we're going to fall behind in the future again. Might as well get ahead of the curve. But maybe that's a better problem to have than undercorrection.
Ratib, I think there's also an issue of the type of correction that's going to be done. So I get the sense like if there's going to be an overcorrection, so to speak, it may not come from like careful, disciplined, empirical work, but rather people are being maybe less disciplined in their approach. And as a result of that, I think are going to wind up working against some of the consumer interests, basically by being followed by a reactionary cause against antitrust. So I think we do as we ramp up enforcement in this country and around the world, we have to be careful that it's done in a sensible way so that we don't wind up with a backlash and people pointing to obviously bad research or otherwise. So it's good to see the sort of work that's being done here is along the vein of careful empirical findings.
Just want to quickly second what Bruno said. We're also getting people outside of strictly defined IO field to be interested in IO. Bruno is one example.
Thanks.
And a quick follow-up question I want to ask. So Equitable Growth is an organization that seeks to translate research for policymaking. So I want to know, what are a couple of key takeaways that you'd want to make sure policymakers or the public can have from your research?
I mean, I could start. I think that much of the discussion about Amazon has taken very much a private equilibrium view. And I think what I'm trying to do is to really take more of a, really think about the endogenous response that the platform that is going to have and really discipline the incentives in a careful, sort of empirically driven way to try and, really answer the question of what would happen and what should be done much more carefully. And so I think the message I would have is that, some of the policies that have been proposed, at least according to my analysis, would decrease welfare, right? And so we need to think a little bit harder about what we should be doing. I'm trying to do some of that, and I hope other people will as well. But I think from what I see is I think some of the policies that are on the table are not quite the right policies. Others might be, but we need to do more work to really justify that they are the right policies before they're implemented.
I think I'm going to second Germán's point. There's a lot of research floating around, good research floating around about what are appropriate steps we should be taking in terms of antitrust enforcement, and heeding to those research is going to be the way to go. In both my academic research and industry experience, I've seen a lot of bad decisions being motivated by personal and or non-personal other agenda that is not informed by empirics. It's okay to have agendas as long as it's backed by some form of empirical work, and that's what I want to impress upon everybody.
in terms of the takeaways from my own research, I would say that so my research has really tried to connect the macro side of things with the IO approach. And so one thing that I think, regardless of whether, even if you don't believe anything about how I model firm behavior in my specific setting, one thing that I think comes out from my analysis is that a world with market power is increasingly different in terms of consumer surplus, total surplus, from a world without market power. So in some sense, the stakes are becoming larger. And so I think that the takeaway for policymakers is that perhaps is today more important than before to have antitrust agencies that are well-resourced and well-staffed. And it's not just a matter of money. I think it's important also to make sure that you create an environment in the agencies where very good people want to work. One good antidote against keeping the best economists away from working in the antitrust agencies is to keep them very bipartisan and focused on the scholarship. So that would be my takeaway.
Bruno, I don't mean to put you on the spot here, but have you thought about any of the policy strategies that we might use to address the common ownership problem, whether or not it exists or could exist, and you're exposing that it would be a huge problem if it did exist?
So I have heard about a policy proposal contained in a paper by Fiona Scott Morton with Posner and Weil, I think. This came in an antitrust journal that was proposing restricting ownership of firms in the same industries to a certain percentage. That is the only policy proposal that I've heard of. I am a bit skeptical because it doesn't, in some sense, account, and by the way, my paper neither takes into account the benefits of diversification. So one way in which common ownership, the rise of common ownership benefits consumers by offering them the opportunity to hold the diversified portfolios. I would say that more likely, if we wanna do something about common ownership, we don't necessarily want to restrict holdings, but we want to perhaps act on the type how investors can exercise their voting rights rather than restrict their holdings. I think that will be a perfect. I mean, if you in terms of these two broad remedies, and I know that I'm not getting very much into the specific, in terms of these two broad approaches, I think acting on the voting rights is generally preferable because it will not affect in some sense the gains from diversification, from portfolio diversification.
Sure.
Great. We are almost out of time, so I think this is a good good spot to wrap up this panel. Thank you so much to all of our presenters and discussants for presenting such riveting research, and thank you to all of those who've attended today. This session will be available for replay in just a few minutes, and you'll be able to find the recording on the session page you use to access this live stream. That's it for this panel. However, I encourage you all to attend today's plenary session on what's next for federal economic data in just in 30-ish or so minutes. So thank you so much, everyone. Take care and have a great rest of your day.